Hello, and welcome to the next episode in our How to Apply IFRS 16 video series. I'm Jessica Taurae. I lead our global technical team for lease accounting under IFRS. I'm joined today by Avni from our UK technical team, who specializes in real estate leases. Today we'll talk about identifying components of a typical real estate lease. Avni, could you explain what we mean by components of a lease?
Yeah, sure. I mean, arrangements often contain more than a lease, and that's really common in real estate. So a really common example is an arrangement may contain obviously the lease of the real estate property, but also maintenance service, and then perhaps property taxes and insurance. So within that you have clearly some lease components, but you have some components that are non-lease components. And in the past, given the vast majority of property leases are operating leases, perhaps repairers weren't as bothered. All of these expenses hit the P&L, whether they're a lease or a non-lease component didn't really make too much of a difference. However, with IFRS 16, clearly it does make a difference because leases go on balance sheets. So there's much more focus on this distinction between lease and non-lease components.
And of course, it depends on facts and circumstances.
Absolutely.
In terms of whether there is a non-lease component there.
Absolutely.
But in the context of real estate leases, what sort of components should companies and clients be looking for?
So if I take those typical components that I just mentioned before, maintenance very typically will be a non-lease component. And the reason for that is you're looking at what the tenant or the customer or the lessee receives. And certainly with maintenance, that is a separate service. They get a separate service outside of the property. With property taxes and insurance, there isn't really a separate service that they're benefiting from. It's all really wrapped up in that lease component, that lease of the property space. So that very likely would be a lease component and not a separate service.
And so even though if the contract separately identifies them as separate components, doesn't necessarily mean from an IFRS 16 perspective in the guidance that you're allowed to treat them as a separate component.
Absolutely. And the key thing is just looking at the overall arrangement. So sometimes some of these arrangements can be structured over several contracts. So you might have a contract for the property lease, the maintenance, perhaps a marketing agreement, and several different payments going on. And you'd have to look at the combining guidance in IFRS 16 to figure out actually should you be combining all those contracts together and assessing them together. And we've actually got a link to some guidance and another video on that piece as a link to the bottom of this video. The other thing to be mindful of is not all of these payments are going to be made to the lessor, which makes it sometimes a bit tricky. So sometimes for property taxes and insurance, those payments actually might be made by the lessee directly to the government agency collecting the tax or directly to the insurer. But irrespective of that fact, you still need to include those payments within your overall lease payments. So it's mindful to be aware of those payments as well and don't discount them as being excluded. So it can be quite judgmental.
Thanks, Avni. So lots to think about there. In summary, for each lease, you have to consider all of the services you're receiving and the payments that you're making to decide whether they can be separated as non-lease components or not. In our next episode, Avni's going to join me again to talk about how you measure and allocate the payments when you have non-lease components or if you have variable payments for things like insurance and taxes. Hopefully you can join us then, and for more information, please visit pwc.com/IFRS 16. Thank you.